Good morning, ladies and gentlemen, and a very warm welcome to this mortgage market debate, a sort of extraordinary general meeting for lenders and advisors. What with the ongoing cost of living crisis, the rising base rate and volatile swap markets continuing to impact borrower affordability, product availability and pricing, there's never been a greater need for a calm, collected and collaborative approach from everyone in the mortgage industry. In these testing times, it's vital that we keep the lines of communication open and encourage honest dialogue between lenders and advisors. So I'm delighted to be joined by four very senior representatives from the industry who'll spend the next hour discussing the current market, its frustrations and how we can help each other through them. We'll look at the mortgage charter most lenders have now signed up to, its practical implementation, potential impact, and we'll address the challenges that mortgage advisors face today and in the coming weeks, months, and even years as we confront the new normal. We'd be delighted to hear your questions and your observations, so please do click on the speech bubble icon on your left, then you can type a question in and I'll put them to the panel as we go through. Apologies in advance if we don't get to answer everyone's questions. We'll have to see how we're doing for time as we go through. So without further ado, it gives me great pleasure to introduce our panellists. They are Amanda Bryden, Head of Halifax Intermediaries and Scottish Widows Bank, Chris Pearson, Head of Intermediary Mortgages, HSBC UK, Kevin Roberts, Managing Director of Mortgage Services at Legal & General. And in a last-minute change to the lineup, I'm afraid Brad Fordham's been called away, so we are joined by Graham Sellar, Head of Mortgage Business Development at Santander UK. Thanks, Graham, for stepping in at the last minute. Welcome, everyone, and thanks for taking part today. So let's get straight into it. It's feeling pretty difficult out there for borrowers and brokers alike, and it's no picnic for lenders either. Are current market conditions as bad as 2007? Can I ask that question first to Chris, please?
Yes, absolutely. Thank you, Paul. And hello, everybody. I think my response to this would be, I don't think you can compare the two economic cycles. I think we're almost comparing apples and pears to some degree. Back in 2007, if you like, that was more about sort of liquidity constraints, capital constraints, mainly in the lending community for quite a lot of banks. Whereas today, it's all really about, I guess, that this increasing rate environment, pressure on, I guess, household budgets and affordability. What I think is absolutely the case, and the difference between 2007 is lenders are out there and very, very willing and capable of lending. They're all very, very well capitalized. So I don't really want to compare the two history. We're moving from historic lows to a relatively new normal, but we're not moving to historic highs. We've seen much higher interest rates than this. What we're seeing is a jump between historic lows and an environment that we are at the moment. So I think it is difficult to compare the two.
No, fair enough. Amanda, do you agree?
Yeah, I completely agree. We're in a completely different place from a banking environment. There was a lot of cleanup of the industry done after the financial crisis. That's put us in a really good place. And actually, it's put customers in a really good place as well. So I know it feels really tough out there. It feels tough for us. It feels tough for brokers, and ultimately feels very hard for consumers. But we are stressing people's affordability and have done for some period of time at a much higher interest rate than what in reality they have been paying over the last few years. So I think what we're finding at the moment is customers are having that shock of actually no one wants to pay more than what they have been, but affordability has been played out to be able to do it. So I think we're in a very different position. And look, we really do want to lend. And I think you can see that across all of the lenders. We certainly came into this year looking at what do we think the challenges are and how can we help borrowers? So lots of tweaks to policies, lots of ways of working around affordability. So yeah, absolutely agree with Chris.
So it's very different. Graham, is this, we've mentioned the phrase a few times already, is this the new normal then? Is it going to stay this challenging for the foreseeable future?
I can't believe it's 15 years ago, Paula. I must think people, you think time goes really far. I mean, lots of people listening today or watching today will think, interest rates have been low for a long time, and yes, they have been, and they've been low for over a decade. I've been in the industry over 25 years, like probably most of the guys on the call, and interest rates were this high before, but it's a shock when it happens again, I must say. So, 6% mortgage rates were last with us. After the mini budget for a couple of weeks, but prior to that, it was 2008 where we saw pay rates at 6%. So, yes, it is different, as Chris and Amanda have both said, but I think what's different what's the same is pay rates are at 6%, and therefore customers are having to pay more of their disposable income on their mortgages, and with the cost of living and all the other bits going on at the same time. So I think it's bringing back to me what happened in the past, and actually a large part of your take-home salary needed to pay for your mortgage is something probably people have forgotten about, and it's coming back again. So I think it's interesting in terms of how it's moved so quickly. It's not new, but it is new to probably to a lot of people on the call.
Yeah.
And it is normal. I mean, what does everyone else think about how long this, are we just going to have to get used to higher interest rates for the next decade, for example? What do you think, Kevin?
I think this is normal. I think what has been abnormal is the very low interest rate period we've had for a number of years. So yeah, we're back to normal. And yeah, I think this is what we've got to deal with now for the foreseeable future.
So if that is the case, and it's caused a lot of frustration because it's been quite shocking and it's happened quickly, there's been some tensions in the industry, obviously. Are we doing a good enough job of explaining how market restraints and the impact of the quickly rising rates are having an effect on lender and distributor activity and decision making? Are we communicating well enough? Does everyone understand what's going on?
Mm-hmm.
And can I ask that question first to Amanda, please?
Yeah, look, I think it's a really good question, and I think it's a really good opportunity for us to just acknowledge actually the incredible work that colleagues across the entire industry have done to collaboratively work together. So both colleagues from AMI and IMLA have come together to bring together the Working in Mortgages, website, which has an incredible wealth of information. And in fact, only recently, there was lots of information that you can go and read and really understand the mechanics of how the lenders lend. And I think that's really important. Look, myself, I know my colleagues on the line here now, we do a lot of engagement with brokers, whether that be come and see us at different events that we hold, where we talk about economics, we talk about fraud, we talk about tech. There's a lot of education that we want to do. And all of us have, on this call here, really robust BDM teams. I mean, we've got an incredibly large BDM team that want to engage. But we do have to acknowledge that in times like this, where it's really frenetic, where brokers have actually said, I've not got a lot of time in the day to do the actual day job. How do we engage those brokers and educate whilst they're really busy? And so I think it's been really important that we go out and ask brokers, what do you want from us? What do you need? And that's where that AMI and IMLA collaboration has probably really come to life. And, there's a wealth of information. I definitely would say go and have a little look at that. Come and listen to us as well. We're absolutely happy to share. And of course, UK Finance have some brilliant materials as well to lean on. So a hard one, Paula, because, we want to do lots, but it can be overwhelming. So how do we get the balance right? And we're open to any feedback on that. Absolutely.
Graham.
Yeah, I mean, just to repeat myself, I think it's just worth, looking around the room where you are now. I mean, I know looking around the Santander colleagues, so many of them weren't here back in 2008 when rates were last at 6%. In terms of our broker community, how many of, you guys have started since that time? And the customers on our back books, I mean, a large percentage of our customers have been used to low interest rates throughout that time. So education, there's lots of things need to be explained to what's happening, what does happen, what could happen. And certainly I'm seeing queries I haven't seen for a number of years around customers struggling, repossessions and all those types of queries. And it's just sort of making sure that everyone, with customers understand what questions they're going to get asked and give the information. So to Amanda's point, as lenders, we just got to make sure we allow our guys the time to learn what's happening so we can educate the brokers and the market as well.
I have asked for observations and for questions. We've just got an observation from Gary Price, who says that while rates may not be as high as they historically have been, the cost of living and wages make this feel as bad or worse than double-digit rates, which I think we'll all acknowledge. And a couple of people have asked, and you're not going to like this one because I'm going to ask you to get your crystal balls out and be economists. When are we going to see the peak of interest rates? Can I ask all of you that one? Can we start maybe with Chris?
I'm certainly not going to get my crystal ball out on this. Many economists have tried, and I'm not sure anyone's going to get this one right. I think I'd point to inflation. We had a bit of good news on inflation this week, so let's take those as positives. But inflation needs to come down quite some way yet before we're going to see any different sort of real trajectory on mortgage interest rates. So I think we're going to be in this environment for some time to come. And I think we need to see a lot more on inflation before we're going to see that sort of almost reversal in that trajectory. So I think we're going to be in it for a while yet.
Does anyone have a different view on that or anything to add? Or should we move on to the next?
Yeah, I'll just say, Paul, I mean, there's a couple of nationals yesterday, Independent and the Times, both reported mortgage rates are falling because swap rates came down. And then they reported that, the average 2-year rate was down by 2 bips. I think, if I'm a customer and I'm sitting at home and I'm reading those publications, I'm thinking, oh my goodness, rates have fallen. I've got to speak to my broker, I've got to speak to my bank. But, 2 bips is pretty much flat, isn't it? So I think just to be wary of the sort of the hysteria around the media, I think we will see a lot of rate conversations happening in the next few weeks. And it probably takes all of us just to explain, to Chris's point, the rates might drop slightly, but they're not going to change fundamentally. And we won't be seeing rates below 1%, I don't think.
Yes, it was a change to see some positive headlines, but yeah, when you don't plug into it, obviously, as you say, not huge news. Here's one which I'm sure we will get questions on, but I'm going to ask it first. And there's been a lot of publicity about it, but can we expect any progress on product withdrawal notice periods? Can I ask, Kevin, what do you think about that first? Obviously, you're representing the advisor community here.
Bloody well hope so. So a big plea to lenders here. Look, I know the lenders will come after me, and the Amy Imler document on the Working in Mortgage site that Amanda's already referenced. Please go and look at it. And I do have lots of empathy for lenders, and I think we have to be careful of unintended consequences if we're to ask too much. But there are a few things. We've had examples of minutes worth of notice. We've had examples of letting brokers know after products have been withdrawn. We're pulling products out of hours. These are some of the things that are unhelpful. So yes, I get the need for lenders to remain flexibility, and I don't think I'm in the camp. And did quite a broad sample of certainly our key partners beforehand, and I think there's a lot of understanding that we have to be careful what we wish for with unintended consequences. If we want to force lenders to do things, I think there'll be less fixed rates. I think there'll be less choice. I think there'll be more caution, etc. But there are things that lenders, I think, can do better. Spoke to one lender that they've moved their pricing committee from 3 p.m. in the afternoon to the morning, meaning that they're making the decisions earlier in the day so they can put it out, so that they're going to market in the morning, not late afternoon. I think lenders can get better at tranche management. Yes, they've got to manage that, but where's the scenario planning? Surely if you're having a pricing committee early in the morning, you might be thinking, well, what happens if so-and-so pulls their rate and we're left at the top? There must be a range of scenario plans so that quick decisions can be made as early in the day as possible. So I think there's things that can be done. Shout out to Nationwide. You can book the fund at dip stage. So yeah, I'm not in the camp, and I don't think some of my colleagues, certainly Amy and certainly the key partners that I speak to, are into mandating 24 or 48 hours. But there is a massive plea there. This is putting really huge strain on brokers. It's disrupting their lives. One broker's not been able to take holidays because he's worried about he's missing rates for his clients and things, working into weekends and that kind of stuff. So I think, yeah, let's not look at some of the structural issues, and I've got empathy with what the lenders want to do, but what around some of the operational issues? Can we be making decisions earlier in the day? Can we be given as much notice as possible? Can we do more scenario planning? I think there's things that we can be doing, Paula, and a big plea that we do need to continue to look at this, please.
So over to the lenders. Chris, can I come to you first?
Yeah, thanks, Paula. I was expecting this question, actually, and in many ways, I'm glad we're trying to address it. And I just want to start off with recognising the challenge. We do get it. We're not thinking, to heck with brokers, we'll just pull products. We've very much got brokers at the heart of any decisions that we make. It's not a decision any of us will take lightly. Kevin's articulated a few areas that perhaps, as a group of lenders, we could perhaps do better. I think we need to look at all these areas for absolutely certain. It's a funding. We've got funding volatility that puts consequential pressure on services. I'm sure every lender has different funding models as well, so it's not quite as simple as one size fits all. I think we need to recognise that, and certainly from our perspective, where we can practically give 24 hours or more, then we will certainly look to do that. Unfortunately, that's not always possible. So I don't think we're going to come up with sort of a notice guarantee on the back of this discussion. I think it's just worth flipping it on its head a little bit as well, just getting away from short notice periods. It's worth just looking at how long some lenders have been out in the markets with very, very high value for money, high value products. So some lenders have been out there at very, very tight margins, sometimes for a week or two at the top of sourcing systems. And the reason for that is that we're trying to put good quality liquidity and good value liquidity in the markets for customers and borrowers to take advantage of, new business and particularly product transfers. But that does have to come to an end at some point, and that's where you get these sort of short notice period. But sometimes rates have been out there for a week or even 2 weeks. So it's just worth just considering those aspects as well.
Thank you for that. Other lenders like to comment before we move on?
I think I would just add actually to what Chris just said there. I think that's a really good point, because if you look at over the last few weeks, probably what doesn't get spoken or noted as much is the fact that we have tried to hold rates wherever we can for as long as, but it is incredibly challenging. But we keep ourselves honest. Kev, I think all the things that you said there in terms of operational changes, we've started to tweak, and I think you've started to see some lenders already come back with better notice periods. So yeah, I guess there's nothing more to add than that, but they are really valid points. But we are listening, and we do care. No one wants to be thinking that brokers are working late into the evenings or at weekends. We don't want our people doing that either, by the way. We care about our own colleagues, and that absolutely has to be at the forefront of everyone's minds when we're making decisions. So yeah.
Thank you for that. So given all the difficulties, how can lenders reassure brokers and brokers reassure their borrowers in this climate? How can we offer reassurance to all those anxious people, given the reality of the current rates and the affordability backdrop? How do we even start that? Can I come back to you on that, Amanda?
Yeah, absolutely. Look, I think it's all around communication. However you sum this up, communication is absolutely key to all of this. And there are some conversations that we need to have, and have them earlier. We need to be thinking about what might customers face, how can brokers face into them with customers, and be really open with the dialogue. We can't protect people from the harsh realities of the truth, but what we can do is work with people a lot earlier. As lenders, we've started to really make sure we've got tools available that help those conversations. So from a broker point of view, you can come in, have a look at some of the budgeting tools that work with customers. Ultimately, we know that over the next sort of 18 months, we've got a very large cohort of customers that are going to be coming off of their fixed rates and facing that payment shock. So how do you start to engage with them earlier? And look, the fact that you can go and do a PT 6 months in advance is great, but actually could your conversations be coming a little bit earlier and getting people to think about what are the lifestyle changes that you might be able to make? And if you can't, how do we help customers early? What we found very much when it comes to helping customers that are maybe facing financial concerns is the earlier that we engage with those customers, the more likely we are to not see them go into absolute dire straits when it comes to their finances. So regular, timely communication, lots of engagement, I guess, is the key from both sides.
And same question to Kevin, please.
I think this is what our advisors do anyway. Is there anything else? That's what advisors do. Certainly the really, really good ones. But it has been busy. We've had record lending again for the last 2 weeks across the mortgage club. So it is really, really busy out there. But we just have to make sure that we're working on our businesses and on our clients, not just in the sort of the moment, and just keep remembering to pass on. Many of the networks, many of the clubs, many of the lenders do have really good comms out there. So utilize them. Keep talking with your customers. I think that's really, really important. But I think that's what advisors do on a day-to-day basis in terms of providing reassurance, and that they have been doing that because there's been an awful lot going on. And whilst it's great to see mortgages on the Martin Lewis show and the front pages, it does create some uncertainty and drives more calls into our advisors and lenders. So we just have to, sort of take that with a deep breath. But it's good that we're being talked about, and mortgages are in the forefront and the spotlight to a certain extent. So keep doing it, please.
Excellent. Keep up the good work, advisors. So let's move on to the mortgage charter, which obviously I think it's about 85% of lenders have signed up to this with the Chancellor and the FCA. But I'm not sure about whether we all appreciate all of the details, so we're going to delve into some of that and the practical application of the charter. So forgive me for doing this. I'm going to actually read out some of the wording of it as we go through. Bear with me. So now, as part of the mortgage charter, customers approaching the end of a fixed rate deal will have the chance to lock into a fixed rate deal up to 6 months ahead, a new fixed rate deal. They will also be able to manage their new deal and request a better like-for-like deal with their lender right up until the new term starts, if a better one is available. How much of an operational headache is that going to be for lenders? Can I ask Graham that first, please?
Yeah, of course, Paula. I think it's worth just saying when most of us worked through the COVID period, didn't we, where we had payment holidays came into the market at sort of quite short notice. And as lenders, we all reacted quite well, quite quickly for customers, and we went through that process. So this hasn't been so much of a shock because it's pretty similar to that. It's central direction about looking after customers or giving options. What I would say is the majority of the charter is already being done day by day by lenders. So, we were already look not to repossess customers if we can. We'd already look for solutions for customers, how they can make their payments. And generally, we'd all try and offer, PTs up to 6 months before maturity anyway, and generally allow customers to opt for, or brokers to opt for their customers for lower rates if they're available. These things do exist. I think the big change for the charter is putting something in the public domain to try and give confidence to customers that their credit files won't be ruined, and making sure they know there's options for them. But it does bring difficulty. All of us will have operational difficulties bringing that to life. And we just don't know how many customers we're going to have call us. So, will the customers call us? Will they call the brokers? Will they be happy where they are? And again, over the next few weeks, we'll probably understand a bit more. The direction from the Chancellor and Martin Lewis and others is we wanted to be ready or need to be ready for August mortgage payments. So that's why you've seen the majority of these lenders go live with charter rules or charter processes this week. We're going live ourselves next Monday, Tuesday, and we'll be ready. We'll be 6 month PTs come Tuesday. We'll be ready to do the interest only and the term extension stuff from Monday. So, but like I'm sure you're going to go on to, Paula, this isn't payment holidays. This isn't everybody should do it if they're worried. This is about make sure you only do this at the last resort, because it will result in you paying more interest, and it also will result in, ultimately you only get one chance to do these things. So it's coming to the market, and for the brokers listening today, I think you just take the time to understand the rules, because there's a lot of muddled conversations in the media, and actually not everything you read is actually true. So it's making sure you know what the rules are, so you could talk to the customers about what options they've got.
Thank you. And Chris?
Operational headaches for lenders. I'm sure there'll be, on this particular call, not many violins, or be the very small ones if you listen very carefully for lenders. But yeah, look, not much more to add to what Graham's already said. It does have its challenges. We've had to rapidly deploy a lot of these components into systems that sometimes you're having to round holes and square pegs and so on and so forth. So there is some detail still to be sort of worked through, and we'll be continuing to work through as we go along. It's been critical we get a rapid deployment so customers can benefit, and there'll be some inevitable manual processes as well. So lots being done behind the scenes. As Graham said, we're not sure what the take-up will be, but we're going to have a team of people to be able to engage with customers on that. And again, scaling that is obviously a little bit of a challenge. I'm sure we're going to have some lender colleagues on this call as well. So I am going to give all them a little bit of a shout out as well, because it has been a lot of work put in to get this live, but we'll have to work through the detail as we go. Thank
you very much. We've just got an audience question. Skipton now offer 12-month mortgage offers. Will any of the panel providers follow suit? Anyone like to take that, Amanda?
Oh, it's a great question, and it's something that we look at all the time. When it comes to offer length, it does depend. Again, that pricing does have a massive impact in that. Also, when you've got the properties and you're looking at house price index, where we are starting to see movements in house prices, that does make you start to sit and think, okay, what's the right thing to do when it comes to offer lengths? So it's not something that's, I would say, for us personally. We have instances where we have longer offers. So new build is a really good example where you might want to have some flexibility. Is it something that's on our pad for an immediate change? No, but I will take it away, because if that's something that people are looking at, then we'll go back to our teams and start to play that out. But it's not there today.
Graham?
Yeah, much the same as Amanda. New build, obviously a specialist market. We tend to have 9-month products in that space already. I mean, what I would say the other way is if rates start to fall, lots of brokers would say to you, we have to rework with the customer, on a weekly basis while those rates fall. So, in a rising environment, 12-month mortgage offers is something sought after, but in a falling rate environment, then maybe the current 6 months or whatever does work. So, and we could be getting to the point where rates have reached the top of the cycle. So it's, again, same as Amanda, it's not something we're actively looking at. If the market, stays as it is in a rising environment for the months and years ahead, it's something we'd definitely look at. But I'm more confident that we're probably going to see rates start to fall in the next few months, and therefore maybe that type of question goes away.
Thank you. Back to the mortgage charter and the ability to switch to a new deal right up to the deadline of the one that you've booked 6 months before. There'll surely be new intricacies of advice needed around the timing of taking new products. Kevin, what do you think?
Yeah, there's going to be new intricacies of advice, but polling a number of our sort of key partners, etc., pretty much taking it in their stride. This is what we do anyway in helping customers, and I just think that we just need to be careful about the mortgage charter. The people I've spoken to at the moment, it's been quite a low take up. I'm really pleased that we're not using terms like payment holidays, because I think that was I think that drove people to think that it actually was a holiday, but no, there were consequences, etc. So we've got it there. But if I just look at the current sort of most popular search term for mortgages on our systems at the moment is 35 years. If you look at a £200,000 mortgage at 6.11%, which is relatively typical for the moment, capital and interest is 1,156, and interest only is 1,019. So there's only £137 difference. So actually, when you start digging into the relief and the help that's available, I think that consumers really need to be speaking to an advisor. Yeah, go to the lenders and find out what, but it's not that simple. Is it just switching to interest only and thinking all of your cost of living concerns may go away for 6 months? I think is probably not entirely accurate. So speaking to advisors at the moment to get that more holistic approach rather than just reaching out for these initiatives would be really, really wise. So yeah, advisors again remain at the forefront, and we'll be able to take consumers through some of these steps.
Yeah, sort of extending that point, the charter talked very much about lenders, didn't it? And lenders contacting contacting borrowers. Sorry, is there a threat to the brokers owning the customer or the customer journey in all this? And can I put that one to Chris, please?
No, I don't think so. I mean, just given the fast delivery, as we mentioned probably in my previous answer to some of the components here, we've had to get some of these areas on the pitch quite quickly. So you are going to see some manual processes. There is going to be a little of, for want of better words, some devil in the detail. So, for example, if I'm a broker that's advised a customer on a product transfer, I got that settled down a couple of months ago, 4 months to go before the ERC kicks in, all good. We've got a great deal. What happens if the customer then rings and said, I'd like to use a mortgage charter interest only option? These are the sorts of bits of detail we're going to need to work through. And some of those elements, depending on which lender, every lender will be different. You may well need to go and speak to the lender and see what their approach is on this. There's absolutely no intention whatsoever to squeeze out the really critical, important role of a broker in any of this. Advice always sits with the advisor, in this case, the broker. We don't really want to be getting involved in those really intricate advice conversations. The brokers will know their customers perfectly well and be able to guide them around that, and then look at, as opposed to advice, how does this element that sort of this new ecosystem of a mortgage charter work, and what can the broker do to be able to just guide and talk customers through that. So I think in all this, the broker remains absolutely, the key centre of advice, and I think a real guiding light in what can be a potentially confusing time for the customer and what option really to take. That's when the broker comes into their own.
Excellent, very reassuring for the broker there. Other lenders on this call, I presume you agree? Anything to add? No, all in agreement there.
I'm pleased. Thanks, Chris. And the conversations that we have with senior people at lenders, strategically, I think that there is a real desire to keep brokers at the centre of things. Just unintended consequences, on the coal face. Just make sure that message is going all the way through, please. I think that you want to remain very execution only, and I think there's some real dangers in the conversations that lenders could be having on the mortgage charter, and in sort of making sure that they are executing and not advising, etc. So I think lenders will play it carefully and play with a very straight bat. And no brokers, good advisors shouldn't worry, because they'll be in touch with their customers, etc. If you're not in touch with your customers, if you're not keeping in touch regularly, and you perhaps not been working in your business, not on your business as much as you should have done, then now's the time just to think through. You need to be reaching out to your customers, so there shouldn't be a threat.
Thank you for that. Can I ask quite a technical question here about the charter? So part of the charter says that anyone worried about their mortgage repayments can contact their lender for help and guidance without any impact on their credit file. How does that work exactly? Can brokers assure customers their record will be in no way adversely impacted if they extend their period or switch to interest only, or whatever they might be doing? Graham.
Worried you're coming to me for a technical question, Paul. Anyone that knows will worry for me. How does it work in practice? I mean, I think I've said before, this is BAU, so it hasn't changed. So, if you rang us up and said, I'm worried about my mortgage payment, or I'm worried about my rates are going up in 4 or 5 months' time, what can I do? We would always talk to a customer and say, the rates, how the product transfer works, what they could do potentially with formal contract variations or different bits and pieces. Any of those conversations, nothing affects their credit file, nothing's marked on their file. And what the charter brings is just a couple of extra bits where nothing's marked on their file. So if they do take an interest-only 6-month option, or they extend their term to the retirement age, then again, that's done without anything marked on the credit file at all. However, it is important to know that in month 7, when the payments go back to capital and interest, if that payment's not made in month 7, then that would be marked as an arrears as such on the file. So, I think the point made by Chris and others is that the broker here has a real responsibility, or help lenders, I suppose, help customers understand what they're doing, because if they extend their term, that could be switched back within 6 months if they contact us. But if it doesn't, it stays the same for the rest of their mortgage term. And again, that could lead to extra interest. But if they take the interest only option, it could cause issues in month 7, which is unintended. So how it works in practice is if you're making the payments as contractually you should, nothing's marked on your file. And with the charter bits, there's a little bit of leeway for customers. If you don't make those payments, then something is marked on your file. And I think it is just worth calling out at this point, Paula, that interest-only customers who are today interest-only, and buy-to-let landlords who are today buy-to-let landlords, they're not in the charter. So those customers will still be contacting us, and we'll be still working with those customers in the same way as we are today. But there isn't anything in the charter for them. So this isn't a net it's going to catch all customers. It's a net it's going to catch a certain spoke group of customers. So I think that's worth knowing.
Yeah, and do you think that was a significant oversight on the behalf of the Chancellor, FCA, not to include existing interest-only and buy-to-let? Graham, again.
Yeah, thank you for that. Oversight, I don't know. I mean, in terms of our CEOs, obviously with Jeremy Hunt discussing what to be done. I mean, if you take the solutions switching to interest-only or extending the term, neither of those does any good for an interest-only customer, clearly. And most of us know buy-to-lets are generally on interest-only. So again, same issue. There's not the solutions being offered may not have helped that group. So I don't know whether it was done by choice or whether the solutions just didn't help those groups. The vast majority, I think 90% or so of customers take mortgages on capital and interest. So it's going to help the majority of residential customers, but the customers who are suffering the biggest rate shocks or payment shocks are those interest-only customers and maybe some buy-to-let landlords. So yes, it doesn't help all, but as lenders, we'll continue to work with those customer groups as well. So it's worth knowing which customers could be helped, can be helped, but also it's worth knowing some customers won't be able to be helped.
Thanks for that. Just one more slightly technical one, then we'll move on. And that's the part about borrowers can switch to a new mortgage deal at the end of their existing fixed rate without another affordability check. Can anyone talk us through the rationale behind that? Amanda?
Yeah, I'm more than happy to. Look, ultimately, when it comes to existing customers that are with us, we already own the risk of that customer. What we know and have found through experiences, it's not helpful for customers to not be offered a solution. So we found that by opening up a suite of products for customers that maybe have gone into arrears, we've been able to put them into a much better position than they otherwise would have been. And they can actually get themselves out of financial difficulty a lot quicker, or maybe not go as hard into it. So it's one of those things where actually within the rules of regulation, we own the risk. We're there to support, and that's the right thing to do. So I'm not sure there's a significant amount more to say on that, unless any of my colleagues on the call have. But yeah, I mean, that affordability check becomes almost null and void when you've already got them, and ultimately putting them onto a forced SVR could, in theory, create mortgage prisoners. And that's something we don't want to do. Mortgage prisoners is something that we're very proud of the fact that we don't have, because we always offer a solution. So I think it's just about making sure that you've got a good outcome for a customer.
Thanks, Amanda. So balancing the household budget has been a challenge for many for some years already, and increased mortgage costs obviously are really hurting domestic balance sheets. How can we as an industry help with that wider financial picture? Chris?
Look, you know, it's the picture for every single one of us on this call, isn't it? So we could probably spend a whole day on, and I'm sure Martin Lewis would as well, around all these areas that we could proactively do. So it's a challenging environment. I think we've just got to be very proactive. I know a number of us. I know Kevin mentioned it for his business, getting really proactive before the end of a deal. I'm not just talking when a deal comes up to a PT. I'm talking months, if not even years before that. So just maintain that real positive contact with customers proactively. And I think it's really important to keep customers just informed of the climate that we're in. I know that the papers and the news, it's all over there, but just then translating that into what does this mean very specifically for me as a customer, and what are those things that I can do as a customer? How can you help me as a broker? So just giving some real reassurance to customers from their broker. Where to not to panic, where do you find that help? So, you know, it's not just about the sort of mortgage charter. For certain customers that are in genuine financial difficulties, there are all sorts of forbearance measures that you can put in place where needed. Keep track as well of those mortgage repayments. So, you know, when you've got a deal booked on a product transfer, keep your eye on those. I know most brokers, if not all brokers, are doing that. That's a real value add for a customer. If a rate changes or moves in the right direction through that, if it's a 6-month period, again, you can give some reassurance to the customer that you're always going to get the best possible deal. But I think all these things in terms of proactivity from a broker to a customer, you know, it's a great opportunity. In my eyes, I think you just become the broker for life. Helping them through this period means you become their trusted advisor for life.
Absolutely. Amanda, help with budgeting. Any other ideas?
Completely agree. I mean, that early conversation is absolutely essential. I mean, and I think it's really important that we point out at the moment that unemployment is, you know, still relatively low. I hear myself in echo. It's not very nice. But unemployment's really low, and when you've got low unemployment and people still have jobs, they've still got options, and we definitely find that, which is why today, currently, we're not finding that we're seeing significant rise in arrears. That's a positive, but like we've all acknowledged, that doesn't mean that people aren't about to face payment shock for lots of different reasons: energy, food, all of those things that are really factoring into people's homes. But if you can just start to think about, you know, the way that people are spending, and look, we're quite fortunate as banks because we get a real view of how people are spending their money, how they're using their savings, are they starting to cancel subscriptions, etc., etc. Are they borrowing more? And what we can see is actually there's still the opportunity for a lot of our customers out there to make tweaks in terms of how they're spending their money. I'm definitely not buying as many magazines as I used to because I'm looking after my finances, and I'm doing it all online because I'm being sustainable. No more paper. Another thing.
You heard it here first. It's all about the magazine subscriptions. We've got some questions from the audience. It's a very small font, so if you'll excuse me, I'm going to put my glasses on. The first one is from Ian Stevenson, who says, if rates are 5 or 6 are the new normal, should we be reducing the income multiplier? Letting people borrow 5 times joint income when rates are 2% is very different to when they are 5 or 6%. Can I put that one first to Graham, please?
Yeah, of course. I mean, I come from a world of income multiples, so it used to be 3.5 or 3.6 times single, 2.5 times joint back in the day. But yeah, so income multiples were a thing. MMR came in 2014, as Amanda's reference, where affordability calculations take place. And I think as lenders, we all use loan to income ratios, LTIs as we call them, and whether it's 4.5 or 5, there is also a secondary calculation done on affordability. So I think all of us know that our affordability models use a stress rate generally 1% over reversion. So our stress rates will be somewhere between 8 and 9%, I presume. And therefore, the multiple is a side issue. The affordability's got to be met. So the affordability is tougher now than it was 12 months ago. And as base rate rises, follow-on rates rise, the stress rate will rise. So the multiple is there. As a PRA rule, only 15% of our business can be over 4.5 times. That rule exists. So 85% of our business needs to be below 4.5 times. But the most important thing, Paula, is the affordability calculations have changed with the rising interest rate environment. And therefore, we can be confident those customers, even if rates go to 9% from here, will be able to afford their mortgages. Now, I think we all hope that rates won't go to 9%. But if they do, we've got some confidence that they'll be able to pay their mortgages.
Thank you. I think that was a very comprehensive answer. So I shall move on to next question. From Gary Price. If this is the new normal, property prices will have to fall. What do you expect to happen to house prices over the next 12 months? It's another crystal ball one, I'm afraid. And I'm going to put Kevin on the spot for that one.
I think we can all expect house prices to cool a little. We've had, since COVID, significant house price inflation. And I think with cost of living, I think people are just sitting and pondering a little bit more. So it's taking some of the heat out of the market. But it's only going to be a small cooling. I think read a lot of things. I'm not going to put a number on it, but it's a cooling. It's not a crash. It's not anything like that. I think I've seen 35%. I think that's nonsense. I think if you're looking for a number, it's going to be between 5 and 10%, probably this year, 5 and 10% next year, which is still meaning that house prices will be valued more than they were pre-COVID. Okay, inflation's eating some of that out as well. So, in real terms, there's probably a slightly larger fall, but we still have a massive demand supply imbalance in the UK. So unless we start to see lots of initiatives where we're building lots of houses, I think that there's some structural issues that will support house prices in sort of the short to medium term. So yeah, a cooling, but I'm not overly concerned about anything more than that at this stage.
I think it was the Resolution Foundation came out yesterday and predicted a 25% drop in a year, didn't they? But so you're not agreeing with that, Amanda? Do you have a view?
Well, we've came out. We said we think we'll see 5% probably this year, but a peak to trough of around 10%. So we echo what Kev's saying. You might find that's 1 or 2% either way. I mean, who knows? It definitely. But I think it's really important that we call out the fact that actually there's a really, really bad housing supply. We've got a real housing shortage across all sectors. We haven't got enough homes for the amount of people that are out there. And that absolutely needs to be addressed. We've got a lot of people that should be in social housing that have moved into the PRS, so into the private rental sector. that absolutely doesn't have enough housing in itself. And then that really does make moving into residential, we've got customers that want to buy, they're facing affordability, deposit issues, but there's still that housing shortage, and that does have an impact on house prices. I think it's going to be really interesting, given that we've got a general election coming up, to see what the different governments do in terms of housing. It's likely to be a play in campaigns, but it's been really good to see engagement, not just with the usual lenders, but actually getting brokers involved with that. But it'll be really interesting to see what housing play governments come up with for their general election, because housing is a real shortage. Builders need to have more ability to be able to build. They're talking numbers as low as this year we might have built only 120 million houses. That's a low, scary number. I mean, it could be 150, but that's way off the government target. So all of that plays into house prices. So long answer, but I think that's just another thing for us to think about when we're talking about our market and what we're facing into. Just rates, it's that bigger picture.
Thank you, Amanda. Another question, Steve Ward from Holmbridge. If lenders are serious about helping our mutual clients, would it not be a good move to minimise or scrap early repayment charges on present day products so we can react sooner to move our clients onto better priced products as rates hopefully come down in the next 12 to 18 months? Graham.
Yeah.
You give me all the good questions, don't you, Paula? Technical questions and then ERC questions. I mean, I'm sure others on the call probably will explain it better, but in terms of when we buy money or when we hedge, we're buying at a certain time, and then we have to have that product paid at that length of time, whether it's 2 years or 5 years, and then the ERCs reflect that cost to the lender. So, in utopia, clearly all products would have no ERCs. I know that our trackers have no ERCs, for example, but our fixed rates do. We have changed to a sliding scale, which was obviously happened last November, but those new sliding scale ERCs do reflect the cost to the lender. So I don't think we're going to see that change. I know other markets in the world do have non-ERC fixed rates, but in the UK market, it's something which exists the way we fund. So unfortunately, to the broker asked that question, I don't think that's going to change in the near term.
I thought you might say something like that, but anyone disagree? Anyone planning to scrap ERCs? You would have heard it here first.
We're not planning to scrap ERCs is the answer, albeit all options gratefully received and all ideas gratefully received, but it would have an impact on the pricing models that we currently deploy, so that there's always a trade-off with all these things.
Indeed, thank you. Question from Katie Pring, the Home Partnership. The mortgage charter suggests PTs up to 6 months before the end of your fixed rate. Is my understanding correct that this means lenders can still keep PT windows at 4 months or less? Martin Lewis has said PT windows will be 6 months on TV, but some lenders are keeping PT windows at 4 months using the up to justification. Some clarification would be good. Thanks. Amanda.
Yeah, I'm probably the right place to take that, because I've got the Halifax and the Scottish Widows brand, and so Halifax you can do it 6 months, Scottish Widows is currently less. So in terms of mortgage charter, the wording is up to 6 months, so we don't have to move to 6 months. That said, what you will find is lenders like ourselves at Scottish Widows Bank, we are absolutely keen to try and align our PT window alongside Halifax. But what you've got to remember is there's lots of different size lenders with lots of different system constraints in the background that have signed up to the charter, and the charter is there. Lenders want to sign up to it because it allows consistency. It makes customers feel like, actually, I can go and talk to a lender without fear of credit impacts, etc. Not forgetting all the things we've talked about. But so those lenders that do want to sign up to it, that's the right thing to do, but they can't necessarily get a quick fix in terms of that PT window. So clarity is, it's not 6, it's up to, but we are looking actively from a Scottish Widows Bank brand to see how we can get ours moved as quickly as possible.
Thank you very much. Another question from Amanda Artley of Echo Finance. If you expect a house price reduction, would you expect to see 95% mortgages withdrawn from the market to avoid negative equity situations? Who'd like to take that one? Chris?
We very much wouldn't want to see 95% mortgages withdrawn from the market, and I don't see any plans to do that, certainly in the near term. And from what we've said from the housing conversation we had earlier, we're not, I don't think any of us are predicting any sort of major sort of movement negative on house prices, just a little bit of a cooling off. So we need to keep our crystal balls on the economy polished, if you like. And, you know, we also need to take a bit of this is not a shorter term view. You know, some people could take a 5-year deal, 10-year deal. You know, we can go through an economic cycle where a 95% mortgage can be absolutely the perfect advice for certain customers. So I'm not seeing that as something that we would be looking to withdraw any time soon.
Yeah.
Thank you for that.
Yeah,
Amanda?
I agree. Yeah, no, just to echo Chris, I agree with that completely. And, you know, but it's definitely worthwhile having those in terms of your conversations with customers in terms of foreseeable harm and that risk. So thinking about consumer duty and the principles around that. So having those great conversations, thinking about EPC ratings of property, all of that comes into the mix. So great opportunity for you to show your advice and why you're there to talk to, but definitely not. We wouldn't envisage that, but it would be great again to see what kind of government support might come in, because, you know, we're a big first-time buyer lender, and, you know, 95% high loan-to-value stuff's really important there. So some support to enable that would be absolutely welcome.
It's just to jump in, but it's worth saying the mortgage guarantee scheme, the government scheme, still exists as well at 95%. So I know Santander aren't in that scheme, but I know Lloyds are. So, you know, as the government support those loans, that market will always really exist, and that scheme's there until at least Christmas. So.
Thanks for that. Quite a big question here. Is the mortgage charter compatible with consumer duty? Chris?
Good question. I think we need to have the benefit of hindsight, perhaps, on some of this. I think my stock answer to that would be yes. I think we need to make sure that we are doing all the right things so that it is compatible with consumer duty. As I said, some of the devil will be in the detail on many of these components. But I don't think there are any lenders out here that would see a diversion from mortgage charter to having great outcomes for customers, would be my answer to that.
Graham, anything to add to that?
I would just say the FCA have told us as lenders it is part of consumer duty, and consumer duty needs to overarch everything we do. So, yeah, to Chris's point, we will make sure we do everything we can to make sure the customers get the right outcomes. In terms of foreseeable harm, I mean, you could judge that changing to interest only for 6 months or extending your term is foreseeable harm. I think as long as we give the information to the customer about what are they doing, show them the actual financial impacts, whether that's illustrations online or in paper or whatever, then they can make informed judgments. But there's a thin, you know, the timing is difficult because it's the charters come in, as I said before, within a month. Consumer duty was always coming in on the 31st of July, and the timing sort of, they bump into each other. But the overarching concept is consumer duty is still there. The FCA are telling us, so that has to be the approach.
Yeah, and
Okay.
two of the core outcomes are all around customer understanding and customer support. So there's a nice, you know, link there with it, and that's where, you know, I think all the things we've spoken about today really come into it.
Thanks, Amanda. If anyone has any more questions in the audience, do please get them in the questions box. We've got about 7 minutes discussion time left. I'd just like to ask, given the changing climate, the rapidly changed climate, are there any particular behaviours or threats that we as an industry need to be alive to at the moment? Amanda, can I ask you that one?
Yeah, look, aside from the obvious economic vulnerabilities that we're all currently in, I think it's worthwhile just reminding ourselves that in moments like this is when we tend to start seeing a bit more mortgage fraud. We've not necessarily seen an increase in mortgage fraud. It's been pretty stable, but what we have seen is a bit of a shift when it comes to fraud. So you start to see fraud around income and employment fraud and introducer fraud. So income and employment fraud will be around, you know, people at the moment are worried about affordability. So you sometimes start to see fraudulent documentation and maybe people trying to obtain a mortgage that otherwise wouldn't. Introducer fraud is not about brokers. This is about, though, introducers to brokers. So people that might come to you as a new lead source. And I think what you can sometimes find is when we become slightly quieter as an industry, when brokers are feeling a bit quieter, they might be more inclined to fight to get a case through that they otherwise wouldn't have, or maybe they start to, you know, work with introducers that they could have otherwise steered clear of. So what we would say to you is be vigilant, work with your compliance teams, your networks. If in doubt, ask some questions, do all the good things, because it's that's the kind of thing that we see in moments like this. So, but the good news is we're not seeing big increases. So that's a positive, but stay vigilant, work with your colleagues.
Thank you for that. Now, are there any particular opportunities in the market at the moment which brokers should be thinking of? It's all a bit doom and gloom. Is there anything positive?
Over the next 12 months, as well in excess of 1 million people coming off fixed rates, they are going to need a lot of help. They're going to need our advisors' help, as many of them go from sub 2 to potentially 5, 6, maybe 7% rates. So that's the massive opportunity to be on the front foot. Buy-to-let hasn't gone away. It's still a major part of our learning. It's just different. People's situation is going to be more complex. Advice is never been as important. So from an advisor perspective, yeah, stay close to your customers, and there are plenty of opportunities. Opportunities for lenders will be to increase their PT rates. So I'll just throw that one out there, because we've only got sort of 4 minutes left, and it'd be a remiss of me not to. But the 40.7% of our business in June was by PT, and I know some brokers at half of their business. So if we want a healthy advice industry to remain, which is the major source of lenders' income, we do need to have a discussion on PTs. And shout out to Lloyds. I'm sure we'll go to Amanda first on that one if she wants to respond, because one of the comments from my brokers here, the Lloyds Group will always remain the broker's favourite because of their stance in the PT area. So other lenders, that's what you need to do.
Amanda.
Yeah, well, thanks, Kevin. And look, we agree. It's going to be, if you look at the numbers of PTs this year, it's bigger than the acquisition market. It's the first time we've seen that. And what you can see with people that are doing product transfers at the moment is it's taking a lot longer. There's a lot more advice that goes into it, a lot of reviewing of it. And, our PT model for a very long time, almost 15 years, I think it is now, has been very much to pay a full prop fee. And we do that because we look at the quality and we look at the length of advice that the broker has to go to. So that's our business model. I appreciate other lenders have different views on that, and whether or not Chris or Graham want to speak around it. But yeah, we're not looking to change that, but we do urge brokers to keep making sure that quality of what they do is absolutely spot on, because that's a really important part of why we price.
I'll happy to comment and move the discussion away from PT prop fees on PTs, but to the question, is there any other opportunities? Protection is going to be really, PT is absolutely important. There's a huge cohort of customers that we need to help as an industry. Also think about protection and making sure that those conversations remain live, remain proactive, but really importantly, the customers that you already have got protection policies in with, make sure that they're continuing to see the value of what that protection gives them. So when we're looking at balancing those household budgets, remember that a Sky subscription probably should be lower on the value pecking than your protection policy that you have that protects you and your family. So I think these are really important discussions to ensure those policies remain in place.
Thank you, Chris. That's a very good point. And finally to Graham.
Yeah, I just saw, thanks for Kevin for shouting out our USP. Obviously, that our PT rates are the same across any of our channels, telephone, online, or through brokers. And we have seen a shift of our PTs move into brokers because the rates are the same wherever the customer comes. Brokers can be confident to say to the customer, they're the best rates that Santander is going to offer you. And we've definitely seen a move of PTs being done by brokers, and that's absolutely fine. That's really good. So I think thank you very much for highlighting that USP for us.
Well, thank you very much. That brings us to the end of our mortgage market debate. I know that you're all very busy people right now, but forums like this are really important in keeping that vital dialogue going. So many thanks to everyone for attending. Particular thanks if you submitted a question or an observation. That was very, very helpful, and some of those are really interesting. Thanks also, of course, to our panelists for their insight. I hope you'll agree this has been a very valuable exercise, and I hope that we can keep talking. So thanks again to the audience, thanks again to the panelists, and good luck out there. Thanks a lot.
Thank you.
Thank you.